Welcome to Grab the Horns. I'm Daniel Cooper. Glad that you could join us today. The topic of discussion, what we're going to be looking at today, is really some advice on stock analysts. And the main piece of advice is don't take their advice. We've seen this played out many, many times over the last decade at least, but we're going to go ahead and discuss this a little bit more in depth. So let's begin. When large companies like Enron and Lehman Brothers failed, everyone had the same question in mind. Where are the analysts that were supposed to be there to help investors assess the risk of what is going on? Now, in the meltdown of the real estate and subsequent market meltdown, other rating agencies such as Moody's and Standard & Poor's were also to blame for failing to properly downgrade known risky investments. I mean, these guys knew what was going on, and they kept their AAA rating on some of these bonds that were garbage. 10 years ago and further back, it was crucial for investors to really rely on analysts and their information. Information required to make an assessment on a stock was usually difficult or expensive to obtain. I mean, an IE here, just to take an example, is you look back at companies such as Merrill Lynch, Goldman Sachs. The list goes on from there. Morgan Stanley and so much more that were privy to their in-house research and their analyst recommendations. Now, with the introduction of companies such as Fidelity, E-Trade, Charles Schwab, TD Ameritrade, Scottrade, and so on and so forth, more investors now rely on this third-party type research and market information rather than their brokers' in-house research. Not to mention that a lot of these companies' trades and also just their expenses and fees are quite a bit lower. Now, we've covered a few recent IPOs on Grab the Horns here, and we wanted to take a look at an article. It's actually an article written by Rick Menares, and he provides further proof on why you shouldn't necessarily trust stock analysts. He's writing this for the motleyfool.com. Here's basically what the article looks like, and it's basically entitled This Week's 5 Dumbest Stock Moves. So let's go ahead and discuss two stocks in particular that they talk about. And this is a quote here of the article itself. Shares of Boingo Wireless, NASDAQ ticker symbol WIFI, surged 32% higher on Monday after 4 analysts chimed in with bullish opinions. Wait a minute. Weren't these the same 4 analysts that took the Wi-Fi hotspot operator public at $13.50 just a month ago? Oh, they were. Despite its profitability and slow yet determined growth, shares of Boingo Wireless were smacked down to $7.65 before Monday's orchestrated CPR session. There's nothing dumb about standing behind the poorly received stock that these 4 analysts helped to take public. But why did Pacific Crest issue a price target of $13? Didn't it just promote the sale of Boingo Wireless to its clients at $13.50 5 weeks earlier? The least it could have done is join its peers in the $14 to $15 camp. They go on to say, oh, and if you think that's bad, Pacific Crest also initiated coverage of Chinese social network site Renren, NYSE symbol RENN, with a price target of 11. It was one of the underwriters that took Renren public at $14 last month. Now, this article was written on June 17th, so last week, but it really brings to heart the whole idea of really be careful what analysts are saying, because there's a lot of them out there that say a lot of different things, and you don't know what their underlying goals are for what they're trying to say out there. It's very, very interesting that these two stories that we just looked at with these two stocks, the analysts put out price targets well below where the IPO price was that they just brought public, a number of months ago. So keep that in mind as you're out there looking at the investment world. As always, go out there, go grab the horns.